A lot of people ask me about, what do I do? What do you think the business plan is? Sometimes, for example, buying equipment is not advisable from a business standpoint for everybody, okay? It's not for everybody. It's for people who want to, get into the business. But there's lots of different entry points for the business, and not necessarily, buying some equipment and operating is for everybody. Right. I talked to someone yesterday and he said, hey, I'd like to give me a quotation for this business. I'm going to go out and give all my friends and family. We're going to go and we're going to start something. We're going to dominate in this one particular city. Right. I don't know. Okay. So I just talked to him for a little bit and I said, well, what are you all about? What do you like to do? He said, well, I don't really like to work with a lot of people. I just like to kind of work with my own. And I really am really good at sales and marketing. So he's a kind of a individual contributor. He, makes things happen. I'm a marketing media type of thing. And I'm like, okay, well, probably white labels for you, what I mean? It's probably you would, so I spent an hour and a half with a guy talking him out of buying equipment, which is kind of funny. You're kind of like scratching your head. Well, why does Dr. John do that? Well, that's because I want to, make sure that you guys have the right thing that you're doing. We're not here just to make a quick buck, but we're here to make sure that, that the industry is really serviced with the best talent, and then that they're put in the right places. And I think I can help you do that. So the part of this startup school here is doing that. Now, whenever you need to, go ahead and do your startup school, there's a bunch of things that you need to think about. And sometimes you can just go ahead and educate yourself, we have so many resources for you, podcasts, we have mini courses on a bunch of, they're very, very good. They're highly technical, meaning they do deep dive. You got all the information. If it gets too much for you, you can stop it, start up again. But I do a lot of comparisons, a lot of comparison table, pros and cons. I try to summarize it. A lot of them are my own opinions. At the same time, it's kind of an expert opinion. So other people might have other different opinions. So you can go ahead and look at those. But I try to organize it in a way and then be very fair with how I make my comparisons. So we also have calculators. I mean, Jared and all those guys have been working on calculators, product tours. We have and you can hover over all the little highlighted places, and it'll tell you, okay, this is what it does and this is how it is. So it's a really good learning resource. And then also guides for you guys. So last episode, we talked about a strategic framework and really what that was all about. You got to really begin with the end in mind. I had talked to you guys about that. And, a lot of people go into their business plan thinking that they're going to do everything. Well, you ask them, well, what do you want to do? Well, we want to do gummies. We want to do capsules. We want to do bulk. We want to export to, 7 different countries, and we want to dominate locally and in the U.S. Okay, so world domination. Okay, perfect. I am there with you. But, we crawl, walk, run. I mean, that's how all business is done. It's built up over time, one customer at a time, right? So the way people really are successful is you use strategy to reduce your options. A lot of people think, okay, well, what is strategy? Well, I'm good. My strategy is I'm going to go sell to stores. No, that's actually a product of your strategy. That's actually the strategy would tell you go sell to stores. And actually, a good strategic plan would say, sell to these stores. And not only these stores, but these subsegment of these stores. That's a good strategy, okay? In this particular geographic area. Okay, that's a good strategy. So it's always kind of funneling it down and then trying to look at and understand what it costs to acquire customers, what it costs to, what are the highest, profitable customers, for example. So that's really what strategy can give you. And what we discussed last week was, coming up with your 3 uniques for your marketing plan. We talked about how to identify your values, give you a vision for what your 3-year plan looks like. Also, what that really looks like in terms of financial. So, okay, our goal in 3 years is to be a $5 million company with a 50% gross margin and locations in 7 different cities, starting with city A. Okay, that's kind of a nice 3-year plan, okay? And then also coming up with a 1-year plan in addition to something where you identify your core processes and also your core, how you're going to measure it, what the metrics are that you're going to measure for each of those processes. So we discussed that last week. And, you could probably do, an entire month's worth of podcasts on that, but just suffice it to say that it's an important part of, what are we doing? What are we not doing? A lot of people are making a lot of money just, following, local brands, local options, local, hyper locality. It's a really good strategy. So that's something that we had also talked about last week. Right. So this week, what we're going to do is we're going to talk about the business plan and the financial model. We're going to kind of get into it a little bit about how to build the financial model. Really what kind of elements would go into a management discussion. And, once you get that business plan together, you're really able to create a pitch and create presentation and then also provide all the information for your lawyer to write the private placement memorandum. So these are things that really are preparation for, you going out and starting a business. A lot of people just like, okay, well, I got my product. I'm going to go out and start, selling. Well, that's okay. But a lot of times you need to have money to invest. And if this would be applicable. So if you had a business plan and you wanted someone to invest in you, then you'd need a business plan to show them exactly what you wanted them to do. Right. So that's essentially what that is. Okay. So we're going to get right into this. We're not going to tarry. We're not going to stop and smell the roses. We're not going to do any of those things. We're going to get right into this and hit it really hard. So here's the steps to create a financial model. Okay, first step in creating a business plan is to create a financial model. Okay, now your model can be very complex and it can be very simple. The simpler your model, it doesn't have as much explanatory power, I guess. The more complex your model is, the more explanatory power is, because as you add complexity, you're adding assumptions. And when you add assumptions, the more assumptions that you have in your business plan, the better it is, because you're actually able to say, okay, well, these are all my assumptions here. And then if there are some assumptions that have a great amount of risk associated with them, well, then you can go out and you can talk to people, you can say, okay, well, I'm going to acquire a customer A. Your investor says, well, how many customers A's did you talk to? Okay, that's something that you might want to go out as a part of the assumptions that you're doing in your business plan and say, okay, look, I got this assumption. How many of these can I talk to verify this is the price? This is how much they would be willing to pay. Would they buy it? Those types of things. So right. Those are the types of things that you'd ask for. So I actually have a formula for creating a financial model. And that has to do with basically following these easy steps. Anybody can do it. Easy. It's easy so steps. Easy. No problem. Just check. Okay. So first is to select the products you want to produce. That's really where your strategic plan comes in, right? Mm-hmm. Okay, so I'm going to model 150 different products, 150 different SKUs. Well, that's not really, that you're not really able to do that, right? Mm-mm. So what you want to do is you want to model, a couple SKUs. In other words, sales units, and you want to look at those sales units and say, okay, well, this is how much I'm going to produce over time, right? Mm-hmm. So your strategy will say, you don't want to do 1,000 products. You want to do, 5 products. Right. And those, okay.
Paralysis by analysis.
Exactly. Yeah, exactly. So you don't want to get into paralysis by analysis. So you want to make sure it's all reduced. Okay. So your strategy will reduce the number of products that you're going to model, mm-hmm. right? Right. You're going to follow your strategy because you've talked about it with all of your team. And they've all agreed, okay, these are the products that we're going to go after. We're not going to go after everything else. We're going to forsake all others and be married to these beautiful products that we're going to produce. And then you're going to create a unit demand forecast for each of those products. So I'm going to sell these phones. How many phones am I going to sell per year and per quarter and per month mm-hmm. for the next 5 years?
Right.
That's what...
to get to that final goal that you wanted.
Right, which is basically how much revenue am I going to make each year for the next 5 years, right?
Mm-hmm.
And I'm going to have to show growth year over year, right? I'm not going to want to have to show, hey, look, I'll get this product out, and then I'm not going to sell anything after that, right? So you want to show that, hey, you're growing in your plan, and you'll also want to show, okay, this product is made for this particular market or this particular consumer. This other product's made for this other market, this particular consumer. So you're really able to, understand, okay, hey, look, I got my customer, I have my product, I have my unit demand forecasts. And really what that is okay, I have a product A, and I say, okay, I'm going to sell 5 in month 1. I'm going to sell 10 in month 2. I'm going to sell 15 in month 3, and so on and so forth, all the way out to 60 months, right?
Right.
Okay. That's going to take a little bit of work to do that, right? And there's some simplifying things that you can put in there with growth and everything. You might ask, how in the world do you specify something that's out 5 years? Do you really know? No, you don't. But probably the first 2 years, you probably should have a good idea. Maybe in the first 3 years,
Right. At least a good guesstimate, or more than that.
Yeah.
An educated guess.
Right, exactly. And that should come from your strategy, which is your 3-year vision, right? Okay, we are going to be number 1 in city A, and we're going to be number 1 in 3 major cities in the U.S.
Right.
Okay, what are those major cities? Okay, Los Angeles, New York, and Houston. Okay, we're going to be number 1, which would basically, wow, that would be really awesome. I mean, I think being number 1 in any one of those would be really awesome. So you want to have a unit forecast. Then you set the price for each unit. Now, this is where market research really comes in. Okay, well, what is the price for these units? Suppose I have this widget and I want to sell it, or I have a tincture and I want to sell it. I want to sell it. Okay, my tincture is the best tincture ever. Okay, and it has everything that you would ever want in a tincture. So I'm going to sell them for $200 a piece. Would you believe it? $200. Okay, no one's going to buy it. Okay, or maybe a very small setting is going to buy it. Maybe small amount of people.
Right, for that
luxury aspect. Or the luxury aspect, or maybe it's a medical. Maybe it's a medical thing, and there's something in there that really, people want it. Then you count off all the patients, that would. But you need to set the price for that. So you can do some market research and say, okay, well, go to the stores, go online, find out what average prices are, and what will happen is you'll see prices go from very low till this is ridiculous. No one's going to make any money at this. To very high. And then you're like, well, what do I do with that?
Right.
What you're going to have to do is you're going to have to set the price for each unit, and you're going to have to go all around, and you're going to have to see what the prices are and everything like that. And once you do that, you'll find that there's a range. There's a range of prices, whether some are really low, some really high. You might want to set an average price, okay? There's always going to be someone lower in price.
Right.
I don't, very rarely do you have a strategy. We're going to be the low price leader, unless you're Walmart. Okay. That only works if you have volume. Okay.
Lots of volume.
So there are plenty of people who are like, okay, we're going to go out, we're going to undercut everybody. We're going to go kill everybody. And, okay, so what are you going to do? You're going to basically give the product away, put everybody else out of business, and at the same time, you're going to go out of business too.
Yeah.
Because there's not enough money there to really sustain anything. There are people that actually do that, and then they hang on. They think they got enough money, and then they'll come back. I just think it's a real scorched earth approach to business. I don't understand why people want to do that.
No, it's like
or the other way. Here, I'm going to have a really high end product. I'm going to have all the best packaging. I'm going to have gold plated packaging. I'm going to have all, super, quantities and everything. And I'm going to be half the price of everybody else. Well, what that means is you have no margin, right? So that's really where the next step comes in. Estimate COGS. In other words, what's your cost of goods? Okay. So we want to have the best packaging, all the best materials. We want to have everything, double and triple certified. Well, everything costs money. Right. And that's where that goes. So it goes into cost of goods sold. And then you also have labor, and you have manufacturing overhead and that cost of goods sold. And then you want to estimate the head count after that. That would include everybody, all the accountants, all of the all the executive team, all of the manufacturing team, all of the marketing people that you're going to need, all the sales people. And you're going to want to say, okay, well, this is all the number of people that I need over time, all the way going out to 5 years. You can truncate your model and bring it back to a 3-year projection. But, a 5-year projection is pretty nice. I think there's ways to do it where, the second or the fourth and fifth year are kind of automated. And then estimate SG&A, which is sales, general administration expenses. So, for example, things like lawyer fees, you're going to have those. Insurance, you're going to have that. You're going to have, phone bills. You're going to have internet. You're going to have, someone's got to mow the lawn. Things like that. So those are all SG&A expenses. And then you layer in your loans and your capital expenditures after that. That will create you a nice financial model. So let's kind of go over that and kind of go over what that looks like in reality here. I'm going to press escape, and then I'm going to go to an actual model here. This is a model. This is a financial model. It's an example. It's not real. There's no data here that's real, okay? And you can see here there's an income statement that's being generated by this model. You can see that there's the gross profit that's being generated by this model, and there's the percent of revenue. This gross profit as a percentage of revenue, you really don't want to go below 50% in my view, because if you do that, you're basically don't have enough money to pay SG&A, which is right this. You see this? This is your SG&A right here. So you can see the SG&A expenses there, and there's all the total expenses. So in this case, you look at this year one, this company made $2.2 million on net revenue, but it cost them 1.1 to make it, right?
Right.
And then they had a lot of general administration sales expenses of 3.7. So they actually lost to 2.6 million. So, and you can see that this is the depreciation amortization. This is where capital expenditure really hits your profit and loss statement. Okay. So, 10,000 was hitting your profit and loss statement. What you do is you buy capital equipment, say it's $2 or $3 million worth of capital equipment, and then you depreciate that over a certain number of years. So maybe it's 3 years. That means you take the total amount and you chop it up into 3 years worth of increments, and then you add up all of those increments and you put them on there as a function of time. So you can see it's not hitting your income statement. How much you're spending on your capital equipment is not actually hugely impacting your income statement.
Right.
Okay. And this, of course, is what's right here. Right here is where you get this net income is where you get taxed. So in this case, they wouldn't pay any tax, but here they would pay some tax. You see, $829, right? $1,000 on that, 4.5. Okay. So that is essentially the profit and loss statement. Now, the way you go about building this is something that looks like this. Okay, this is a kind of a table of results here, and here what we have is we have a bunch of different products in here. I'm going to scroll up to the top. Okay, and here's the inhalation products, for example, tinctures, topicals, edibles, bulk products, pet flour. Okay, anything that you guys could ever think of, and this is essentially the sales. So this is how much in sales you would get from each of those products. And you can see this is a forecast out 7 years. And what you would do is you toggle these percentages, and the percentage increases would go up and down. And this sales here is calculated from, obviously, the price times the number of units, right? Well, I got 10 units at $10. That's $100 in sales, right? Mm-hmm. So that's what that is. So here, obviously, you need to set the prices for each one of those products. And then as you keep going down, you would set the direct costs right here. You can see that. So there's a direct cost here that you're setting. So you take the cost times the number of units, and then that will give you the sales. And once you have all of this set, you really have the first step in creating your income statement. You can see right here, let's go back to the income statement. Now you have this really made up where you have all your products. You've said, okay, here's the products that I'm going to have. Mm-hmm. Here's how much they cost me to make right there. And once I take the 2 million once the gross profit would be 1 million there. So actually, let me see here. What is this going on here? Maybe. Oh, there's just, this is probably an addition. So this is the total, this is the materials, and then this is total COGS. So this plus this is materials and labor. So $75,000 in labor, $1 million in direct materials. You take 1.075 minus that, 2.2 minus 1.075 is 1.164. Gotcha. So that's how you get up to those numbers. So with that model that we just looked at, this is how you create that first set of revenue. Now you need to go and you need to check out how many people in SG&A and how many people in production do you need to actually get this 2.2. Well, you need salespeople, right?
Right.
Well, you're going to have marketing people probably too.
Right. Let people know what it's there.
You're going to have accountants because somebody has to count the money.
Yep, that's right.
What else are we going to need? Well, we're going to need the janitor.
Yep.
He's going to have, we got to have that, right? What else do we need? Do we need to have some executives on board? Maybe. Probably not every executive. Maybe you can, kind of economize, starting out. Mm-hmm. And that's why you need to really layer in a plan for your different personnel. And that's where you get this right here. This right here is, there you go, right there. So here's all the different types of people, accounting, plant managers. Here's how much you'd pay them and then what month they're starting. So you can see that you can really layer in a whole entire plan for people and then how much they're going to be paid. And also we'll give you, total senior management headcount, total salaries and benefits headcount. You can see cumulative, right? Mm-hmm. So here's some development people. Maybe you need some development people. Maybe you need some different salespeople, obviously. Maybe you need some marketing people. You can see there, and some production people as well. This number right here gets added into the COGS, obviously. So right. that's where that number comes from. And then customer service, and maybe you also have a model for, for maybe you need some nurses on staff or pharmacists or whatever. And so here is what you get out of that as a headcount plan that looks something like this. And that's pretty nice to see. Hey, look, here's the years. Here's how many headcount we're going to have. In the second year, we're going to grow X amount. Here's how much headcount we're going to have, and then we're going to kind of level off. So, right. This is very valuable for an investor understanding what your plan is over time. Right. Okay, well, here's how many people I'm going to have. Here's the amount that I'm going to have. Here's how much money they're going to need for salaries, all that stuff. So that's that really then gets you to this right here. So we figured out how to make this. Now we're going to figure out how to make that by adding in all of the head count. And then you also need to have the expenses. So not only the head count, but the expenses, meaning, things like, let's go up and I'll show you what that is, like rent, maintenance, equipment maintenance, hiring, expenses, legal, licensing, all that stuff that would normally be considered to be SG&A expenses. So those are called SG&A expenses. And though all of those things then, you can see right here, we got 3.4 million. That's a lot. Oh, yeah. That's a lot. So I think in this case, what we would do is we'd probably reduce that to $1 and $1 and, to try to get that 3 million down there. Right. So here, look at, where's the main contributor? Okay. Marketing expense. Oh, shoot. We were going to make a lot of money. No. Oh, they caught us. Yeah, they caught us. Oh man, we were going to, they caught us. Okay. Well, I guess so. No, they just reduced us to $1. Okay. 1.3. I bet we could even make this, these are per month costs. That's why I'm putting them in $1. So
I see.
You can see that. So there. Oh, $6.49. In fact, let's go back to our income statement. We might have made this company profitable. look at here. So now we got 1.1 in gross. You got to subtract 9. And now look at they're profitable. Woo! So that tells you, okay, look, you can't have $3 million in expenses, you know.
Right.
If you're a normal company. If you're a public company, you can continue to lose money for years and years and years without impunity. But real companies that make money can't do that. Okay. So then we have year 1, year 2, year 3. You can see this, see how this goes. And then interest expense also. So now we've created actually we got down to EBITDA. And everybody talks about EBITDA. Why is EBITDA important? Well, this is earnings before interest, taxes, depreciation, and amortization. Okay, that's what that means. And why is that important? Because people typically will pay, like if you're going to build a company up, and they want to buy your company, they will pay a multiple of EBITDA. So 3 times EBITDA, 10 times EBITDA. So in this case, they, you know, if it was 10 times EBITDA, they pay $2 million for this company in year 1, you know. But usually you have to have more than 1 year's worth of, you know, financials to really show, hey, this is sustainable, this is doable, I continue on here. You know, to your typical financial buyer, you'd have to have 10 years worth of financials, all showing growth of 100% year over year, and then they give you a 2x multiple on EBITDA. Okay, that's just my jaundiced view, but whatever. It's you know, what my point there is that everybody has their own multiple, and everybody sees your company with different value. So a financial buyer will try to discount your value. You know, typically on public markets, they reward value. They reward it quite well. I mean, the valuations in public markets are at least 10x higher than they are in private markets. Wow. So, you know, that's why a lot of people want to go public, because they're able to raise money, and they're also able to get a better valuation for their company than what, say, a strategic buyer or a financial buyer will give them. Certainly better than a financial buyer who is always trying to find, you know, the best deal. Right. Just, yeah. So I think what we did, interestingly enough, just with those 2 things, you see how that we followed the formula, right? Well, we got the people, we figured out how many people we'd need. We got our products, we figured out how much those products cost, and we put a price on there. We got a forecast. So now we know how much gross profit we're going to make. And then we said, hey, here's how much we're going to have in expenses for our SG&A. And then all of a sudden there, I'm left with an EBITDA number. And if you do that, you know, 7 times, you have 7 years. Right. So that's basically what it is. Now, this depreciation and amortization cost right here really comes from your CapEx. And you can kind of see that right here. You can layer in your CapEx now. Okay, well, here's the capital equipment that I'm going to need. Here's the dates that I'm going to need it. You can see in the year 1, I'm going to need 200, and then I'm going to need tooling in year 2, and another year I'm going to need another tooling. Then I need a booth. You can see I got a plant here. I got land. Okay, I'm gonna buy some land. So I actually need 800,000. 2, 4, 6, 8. Yeah, 800 grand, right? And I'm going to do that the first year. And then you can see I'm going to make here's the investments, okay, that I got, and along with the useful life right here. This is where their amortization schedule comes from, and then you can make up an amortization schedule and accumulated depreciation and all that, and come up with, you know, different debt. You can also put debt in here and things like that. But this is really where you know, I think it's good to do, because mainly because you have a capital equipment plan. Does the investor really care too much about depreciation and amortization in your income statement? Well, it usually is not very significant in your overall plan. And so, you know, that's why capital equipment, it's better to buy high quality, low cost, low operating cost equipment because of that fact. If you're starting a business, go back and look at your income statement here. Okay, where does all that capital equipment end up? Well, it ends up a small portion of it, a sliver of it, based on the useful life and how much is depreciated, is added as a non-cash expense on your profit and loss statement. Pretty cool. So you can buy the highest quality equipment. What does matter is your operating cost, because that's what's really hitting right here, right? So if you buy super cheap equipment and it costs you 3 times the amount to operate, well, you're actually reducing your profit, right? Which is going to hurt your income statement, which is going to hurt your EBITDA, which is going to hurt your multiple. So be careful about how you go about starting up your business. So that's basically the profit and loss statement. And this is the balance sheet. This is the balance sheet. This is kind of when people look at the balance sheet, they get a little bit confused as to what it is. You can see this is the change in the period. So this is a period 1, period 2, period 3, period 4, 5, 6, 7. And you can see that this is cumulative, so that we're only measuring the changes here. You can see assets are growing. This is the assets. Apparently, this company started off with about $29 million in assets. Okay, they had a whole bunch of inventory, and you can see they're growing their inventory from year over year. Right. Their receivables, that's how much money people owe them, how much cash they have in the bank. They got $28 million in the bank. Okay, this is property, plant, and equipment. This is really where all your equipment and all that stuff. So you got $800,000 that you're going to spend. Right. And then you add another $200,000 to that. And so that's why it's $1 million. See, it's cumulative, right? So we added 200 on there. And then here's your total assets. You take assets, minus liabilities and equity, and they should equal. So this number right here, total liabilities and total assets, should be equal. Okay. This right here is an important part, this equity. So if you have more assets than you have liabilities, the difference is really equity. So it's a really good thing to have more assets than there are liabilities, right? And you can see that this is where the cash comes in too. If you have cash and you have cash flow, things that you can do to manage your balance sheet is what they call in the kind of the advanced secret of the universe. It's really not that way, but a lot of the really good operating companies run their businesses, they always manage the balance sheet. And that means that they're reducing their inventory using like Kaizen, and they're using operational excellence. They're reducing their inventory to release cash that can then be reinvested at a higher rate than the inventory would give them. Basically, inventory doesn't give you any return until it's made into finished goods and sold. So it's really no benefit to have, inventory sitting around. You should have as little as possible, in fact. So a well-managed business will have very little inventory. Also, your cash conversion cycle is very important here too. How long does it take me for the customers to pay me? Right. And then how long do I pay? And that's a game, right? Yeah. So oftentimes, what if you have a contract for $1 million, okay? You went out and bought all the stuff for the $1 million, and then the guy didn't pay the $1 million. You're sitting there holding all the stuff. You're going back to your guy and saying, hey, well, look, I can't pay you because this guy didn't pay me. Right. Okay.
I'm going to get more money.
I'm going to get more money.
I need a loan.
Yeah, I'm going to need a loan. Right. Well, then that's a cost, right? So yeah, that's what's called the cash conversion cycle, essentially. And so, that's why a lot of, companies want to try to get paid very quickly, and then also be slow to pay at the same time, so that they can have more cash on their books and stuff like that. So, if you're dealing with multiple billions of dollars, it can become a very lucrative game actually to do that. And so you get a large company. That's why, people want to work with large companies, especially small entities, and they'll stretch you out. They'll stretch you out in payment. They're like, okay, well, we'll put a 90-day payment term on that so that you get paid in 3 months. That's not really fair in my view, but then, the company or the business, they make the choice that, hey, that's okay. That's the price that we pay. We have to hold that. We're holding their costs, and we're paying for their costs on our books, but we feel that the profit that we get from them is more than offsets our slow payment. So there's always a business reason to do that. Okay. Gotcha. So typically terms are how fast do I pay and how fast do you pay, in a transaction, if it was equal, I'll pay you in 30 days and you pay me in 30 days and it's all set. Yeah. So, sometimes sometimes people get caught in a meat grinder though, where one party doesn't pay. That happened a lot in 2020 with a lot of companies where, you know, for one reason or another, you know, the economy went down. You know, people weren't able to pay, and then, you know, vendors were, you know, sitting there saying, hey, you know, what am I supposed to do? Nobody's, you know.
Hands tied.
Man's tied, yeah. So there's a lot of that has gone on, and hopefully we're getting out of that with 2020 and 2021 and 2022 coming up. It's really cooking up in our economy. It's really awesome. So that's the balance sheet, and then the cash flow statement. This is really where use the cash flow statement to articulate the value of your company or the net present value of your company. You take all the cash flows from years 1 to 7 and you add them up and you discount it at a discount rate to today's dollars. And your discount rate really is, what is your weighted average cost of capital? Can you borrow money at 4%? Can you borrow money at 10%? Can you borrow money at 20%? Okay. So if you can borrow money at 20%, that's your weighted average cost of capital, and that future cash flow is worth less at 20% than it would be if you could borrow money at 4%, right? Mm-hmm. So that's really where your credit comes in. That's really where you know, the risk of your business also comes in. So a lot of the people who are advanced in these types of analyses, they will take and they will do a discounted cash flow for your business and really understand, okay, here's what it's really worth.
Right.
And we'll do that with weighted average cost of capital. That's why a lot of people don't like, you know, companies to get like bank loans at really low rates, because that's the cost of capital, right? So financial buyers, for example, they want to buy equity, right? Well, equity is expensive. You know, if I don't have to take that money from a financial buyer, and instead I can get say a $100 million loan at, you know, 5.5%. Well, you no longer have a financial buyer there that'd be interested in that, because they're not going to be your cost of capital's too low for them.
Gotcha.
Yeah. So it's kind of it's kind of a cool thing. In fact, I know for a fact that you guys who have your business, you'll go back and you'll start to say, okay, look, I want to start my business. Okay, now it's up and running, and now I want to sell it. Keep on coming back to this because you'll pick up different things that I'm talking about, because I've been through every one of those phases, and you might not really pick up what I'm saying right now, but if you keep on revisiting this, you'll see, oh, okay, that's what that is. There's some advanced things in there, I would have to say, especially with difference between financial buyers and bank loans and going public. So anyway, so that's that. Now, once I have this cash flow statement there, and this pretty much, you can calculate this from your income statement, your balance sheet. So you don't really need to think too much about how to do it. You have already done all the hard work by putting in your revenue, and by putting in your SG&A and CapEx and your personal. And then the main thing now is that you're just going to get all your charts out. So these are charts that come right out of the model, right? And this is really what you want to be talking about with investors. Okay, so this one right here, for example. Okay, so this is, okay, you can change the words on there, but this blue line is gross profit. This is EBITDA, and this is net income, obviously. So you can see. The reason this is important, this is a function of the year. You can see here that the first year, very little, but it's not negative because we changed it. Remember that?
Yep.
Normally this would be negative here. And then as you hit the second month, you're hitting your sales and everything, or the second year. Here you can see we're just under 20 million here, and we're about halfway there. And you can see that so this is what they call the flow through to net income, right? Mm-hmm. Now, if, you know, some companies, for example, they'll have this huge gross profit right here, and then this net income will be like nothing. Well, why is that? Well, your SG&A is huge, right? So you don't have, it's eating everything up, right? Mm-hmm. So that's why you say, you know, typically the flow through, you want to have something that looks like this. If it looks like, you know, this is half of that, and then this is way down here. Well, what are you even doing? You have all this gross profit, but you're not making anything. Right. There's a lot of public companies that are like that. And then there's a lot of private companies that are like that. This right here is cash flow. So you can see this is cumulative cash flow over time. Mm-hmm. And you can see this nice little hockey stick going way up here. You're making all kinds of cash, you know. And so what you want to do is you want to take all these beautiful charts that you're getting. Here's some more charts. I'll show you some more charts that you get out of this model here. I wonder if I can see anything over here. No new charts. There's lots of different charts that come out of this. There's a headcount plan, obviously. There's a summary chart here. And what you want to do then is you want to go back to my writing formula. Okay. And so now you've done the model. You got all the stuff that you need to do there. You've defined your products. You've forecasted your products. You've estimated your costs out over a function of time, and you got all these beautiful graphs. Now you need to be able to put those into a business plan. So here's my writing formula. First of all, arrange graphs and tables in order. So you start off with your income statement, then you go to your balance sheet, then you go to cash flow statement. So those are the first 3 tables in your business plan. Then you go to your products and your product mix, and there's a little chart in there. And then you go to your customer acquisition plan and then your marketing plan. So that's really what it is. You write captions for each graph. Figure 1, table 1, income statement for years 1 through 7.
Right.
Or you write product mix, like take tinctures and vapors. That's my product mix. That's what I mean by product mix as a function of time. So, and then you can talk about those things. So you arrange all the graphs, you put all of the captions on them, and then you write underneath each graph and each table all the assumptions that you made. So I assumed that, for example, I was going to have a 50% gross margin. Okay, so that would be one assumption. And instead of, maybe I fixed my gross margin instead of calculating my COGS, okay? Right. Maybe I fixed my gross margin, said, okay, I know that this business has a 50% gross margin, so I didn't even look at COGS, okay? That would be an assumption that you need to write about, right, in your plan. Lots of different assumptions on how you're going to go to market, like, okay, I have a product and I'm going to go hit 100 stores in the first year, and I'm going to get 50% of those, and those stores are going to sell 7,000 units each. Okay. So then you got your model there, and you need to say, hey, here's what our plan is. Here's the store we're going to go to. These are the store owners I talked to. That's the kind of thing that your investor is going to want to know you did, right? Right. Otherwise you're just making it up. You're doing the research as you go along. Right. So they want people to know that that's all set. And then once you get all these assumptions down, then you have summarize the assumptions in what they call a SWOT, or strengths, weaknesses, opportunities, threats. Okay, and really what they are is all your assumptions. So you just arrange the assumptions into those 4 different categories. Right. And then you could even bullet point them out. You write a summary. You add a table of contents. You can add some narrative, and you got yourself a business plan. It's not that complicated, but it does. It is mind numbing, and it takes it takes a little bit of time. So I think that if you guys have your strategy knocked down, meaning here's the products, here's exactly what we're going to do, here's what our strategy is. This writing this business plan is going to be a lot easier. A lot of people have a problem with that, writing the business plan, because they don't have the strategy down first. So what you're not doing, that's the key question, right? Instead of what you are doing. So, you can use a proven outline. Here's an example of that. Pro forma projections, what your product lines are. You can talk about product 1, product 2, product 3, what your SWOT analysis is, your financial projections with all the notes, and then your data tables, and then all your table figures. Okay. And this can all be done very nicely in Word. And I have, yes, I do. I do have a little template for you guys right here. So here's a business plan example, along with some pro forma projections. Okay, yeah, current state product lines, future state product lines, what the SWOT analysis is. You can see that. Here's your financial projections. This comes directly from the model that we just made, right? And then here's all some generalized notes on the income statement, what the revenue drivers are, what products, what the pricing assumptions are, what the channel, where you're going to sell it. In other words, what the supply chain is. You have some supply chain assumptions. I'm going to get 7,000 pounds of hemp for free for the next 8 years, according to this contract. And here I have this contract, right?
Gotcha.
Something along those lines. And then some expenses assumptions. Maybe you want to, the simplifying assumptions. Oftentimes you can simplify it like, okay, well, look, I've been running manufacturing companies for the last 30 years, and my SG&A is always about 20%. So instead of saying, okay, here's all the people that I have, and then here's all the expenses that I have, I'm just going to say it's going to be 20%, and I'm going to manage it to that number. Mm-hmm. That would be an assumption. Gotcha. And it would be super easier to deal with. And then here's, again, that revenue breakdown. You can see that along with more business plan, your cash flow. Of course, you would have your cash flow in there. I'm going to page down here. Oh, there you go. You got product mix in there. You can see your online versus retail. So oftentimes, if you have retail, you're going to be selling wholesale or distribution, right? Mm-hmm. So that's a lower price. So you actually would have two different price models, right? Because your online store would have retail prices, right? Right. Mm-hmm. So you might have the exact same product, say tincture A, going into online with a full retail price, or you might have tincture A going to retail at a wholesale price, which would be less. So you're going to need to model that out in that income statement and then build it all up. What this is showing is different retail channels for that. And you saw the graph, the chart that I gave you before, the Excel spreadsheet. That's essentially, you can model it right in there, no problem at all. In fact, the model that I have there is exactly that. So, and then here you can have all kinds of different channel mix. Okay, I'm going to go to club, I'm going to go to mass, I'm going to go to convenience. You can also do kind of more advanced things by saying, hey, look, I think that I'm going to have a planned price decrease in my wholesale price over time. Gotcha. And that way I'm going to gain more customers, and that's how I'm going to do it, because as I go to, like mass market, the prices are going to be lower and things like that. So here I'm doing that. And you can actually take your wholesale price in the model and you can change it according to that graph, or any graph for that matter. You can say, okay, straight line, or it's going to go down a little bit and then it's going to kind of level off or something along those lines. Mm-hmm. Store acquisition plan. Here's the stores. These two graphs right here, store acquisition plan and wholesale price, you would need to have a slightly different model to deal with that. This is than what I showed you, but you certainly can be done easily enough. Here you have your COGS improvement plan, saying that we're going to be inefficient at first, but we're going to drive almost 50% improvement in COGS for your operational plan. And then, how much you're going to spend in marketing, what resources are used for marketing and headcount and all that. So that is a general business plan. And how many people are going to read that business plan? All of your investors, probably not a lot. They're going to skim it, and they're going to try to find some gotcha questions. Okay. What's the benefit of doing that plan? Well, the benefit really is for you. First of all, a lot of investors are going to say, where's your business plan? Okay. But then they're going to proceed not to read it. Okay. And then they're just going to listen to your pitch. But when you do all of this, you have the financial, you know exactly what's going to happen financially. You have the business plan behind you, and you know all of your assumptions. You will have all the answers for them right off the bat. You've seen these guys on Shark Tank every now and then. Even they come into the Shark Tank and they don't know their numbers. They don't know their gross margins. They don't know anything. They're like, okay, well, but I have a great widget. And they're like, okay, you might have had a great widget. You might have won, but you didn't have the numbers. So you just lost. That's it. Right. Because they're not gonna put their money into someone who comes into a high profile position like that and don't know their numbers. So this will allow you to know your numbers cold. And I think that when you're talking about your pitch, which we'll talk about in a couple sessions here, it's going to be really important for you to really have, this is going to be a really important aspect of that. Mm-hmm. So This is kind of a long-winded one. This is a longer one than what we have, but hopefully it will work for you. And we can post some of these business plan examples and also the spreadsheet and stuff. Basically we're probably going to put them in our course, I suppose, so that you can have them right there in the course. And if you want to take it, but this is probably the heaviest lifting one. And I didn't feel that we should have broken it up into multiple sections, just because one session is probably what is required out of this. And so I think that if you put, maybe 5 to 6 hours into, building your model, and then you put another day or so into, basically putting all the graphs in and writing all your assumptions, you will be ready for basically your complete business plan to be done. So I think maybe a couple of days it would probably take you, and that's really assuming that you have all your strategy all worked out. So I hope that you guys got something out of this. Appreciate you guys, and thanks for your time, and you guys take care. Bye now.